Private real estate is the investing in commercial real estate, which are office buildings, shopping centers, industrial parks, hotels, multifamily buildings, things of that nature, in typically a private commingled fund vehicle. That's as opposed to a public real estate investment trust, which trades much more like a stock on the stock market, as opposed to a private commingled fund vehicle, which is a private vehicle, so the underlying performance mimics more the actual performance of the real estate asset itself. Most people invest in private real estate for three reasons. The first is diversification. Real estate is a great diversifier, private real estate that is, because it has a very low correlation to fixed income and stocks. The second is that it's a growth and income vehicle. So private real estate typically has a very strong cash component to its total return, but you also get a strong total return. So in today's world where you have very low fixed income yields and stock dividends are very low, really one of the few places to find good strong cash yields is in real estate. And then the third aspect is inflation protection. Real estate's proven to be very good at providing inflation protection over time, because as the cost of goods and services increases, the cost to build a new property increases, and therefore the values can increase in real estate. Most people think about styles in one way, which is risk. So the different risk styles are essentially core, value add, and opportunistic, where core investing is high quality real estate, major markets, low leverage, things of that nature. So you're going to get lower returns in core real estate, but it's going to be lower stable returns. Then there's value add. So value add is investing in existing properties that may have been undermanaged or undercapitalized, and so there's some opportunity to enhance the value through incorporating capital or redevelopment, releasing of space or leasing of space that's currently vacant. And then opportunistic is at the highest end of the spectrum in terms of risk, and that's where you're investing in development opportunities or distressed real estate opportunities where there's a real high vacancy rate at the particular property, or there's a meltdown in the capital structure that needs to be resolved in some form or fashion. There's really two ways you can do it. One is if you're a very wealthy individual, you can go out and buy your own office buildings or your own shopping centers and the like, but most people look at investing in a commingled fund vehicle, which is managed by an institutional quality investment manager. And they go out and they assemble a well-diversified portfolio of investments across whatever the strategy is and manage those and add value to them and then ultimately sell them and return capital to. So we see most people opting for that route.